Right on. Welcome everyone again. Lovely Saturday. Summer rolling along. Hope everyone's doing well and being able to enjoy some summer travels in the weather. And for those in Calgary, the Stampede, obviously. So I'm gonna keep today a little bit shorter. For anyone that's new, that's joining us today for the first time, I am gonna run through things a lot quicker as I kind of do these seminars. I want to keep them to under kind of hour and a half if possible, and just kind of get through things. If you're more so looking for deeper explanation, some of the older sessions that are recorded, they're on the website, they're on YouTube. Please have a look at them. They will go through things in much more detail, the formulas, what everything means, and kind of the explanation of it all. But I have got feedback that for people who are attending these every week or regularly, it just gets to be the same information until we get to the kind of more of the company specific insight portion. So gonna keep it at that. I know people are busy in the summer anyway, so I'm gonna try and keep them short, especially people trying to watch replays and whatnot. So we'll go with that. I also recently found out that YouTube is putting ads on the recordings, and I did not realize that was happening, but I think it's a necessary evil that they put on. I don't think my account's big enough to generate any revenue, but if YouTube thinks so, then all the power to them. But yeah, we'll get started. A few things up front. I'm not an investment advisor, so please do your own due diligence. Everything I share today is my opinion. It's my interpretation of data. It's how I look at companies, how I value companies. You may have a different view on things. Please also check your portfolio construction and your risk tolerance. These two things, along with due diligence, I think are very, very important, especially in the oil sector. Things are a lot different in value investing to begin with. And as we've seen over the last kind of month or so, the oil industry is definitely comes with its own challenges and rewards. So I'm gonna say that. The other thing, the Zoom and the Twitter will be recorded. They will both be posted here later on. Again, for anyone looking for the previous sessions of the Zoom, they're on the website, whitetundra.ca, under archive seminars, or on the YouTube as well, under White Tundra. I think there's about 50 companies now I think we've covered. I think just about every company has been covered for the most part, especially stuff with Canadian operations. And I think Whitecap, we're on to third or fourth iteration now, and probably more to come as the results roll on, as acquisitions happen, as M&A happens. There's just always a lot to discuss with those things. And the other thing I want to say is about the mailing list. So there's been a lot of people messaging to get added onto the mailing list. And if you do want to get added, I share the files that I'll be discussing about today, along with some of the latest event links and whatnot on there. Pretty informal. It's a custom built mailing list. So if you would like to be on there, shoot me a message and we can go from there. So for those that have attended the valuation sessions before, it's going to be very similar. I haven't really made any changes to the spreadsheet in the past 2 months now. I think it kind of does the job. I don't want to overcomplicate things. I think there was just too many things in there before that were making such a little difference, but we're adding time. So simplified it down. I kind of want to keep it this way. And I know a lot of people do their own customizations and additions, so that's great. But I want to keep the main template simple. So yeah, basically for today's seminar, in a attempt to keep it relatively short, I'm not going to go through where I find the data, because a lot of people attending, I'm sure, know now by following these. And once again, for anyone that doesn't, please have a look at the recordings where I go through things more in detail as to where I got the information and the files and the MD&A and whatnot. So 3 companies today: Crescent Point, Whitecap, Hemisphere. The first two, probably the most direct competitors there are in the Canadian oil patch, whether it's for funding, whether it's for production, share count, free cash flow, dividend. It's like everything is just the exact same, it seems like on the surface. Crescent Point went out and made a huge acquisition last year, the Kaybob Duvernay. Whitecap goes out and makes acquisitions. They just added another big acquisition in the last couple of weeks. And, Crescent Point seems to be on a similar mandate to kind of grow through mergers, acquisitions. They have sold some assets as well. But, two that I wanted to compare and just put the data out there. Interestingly enough, when I was running through this and adding the maps and the graphs and whatnot, I kind of came to the conclusion that the winner between these two is going to be completely subjective, based on kind of what you're looking for. So look forward to share that. And then Hemisphere, it's a company, smaller, about 3,000 barrels a day. It's one I've talked about before. I've wrote a Seeking Alpha article on it as well. So if you're looking for more information, please check that out as well. And I just want to throw it in there because they're working on this polymer flood, and I've been talking more and more about EOR technology being put on old fields with vertical drilling and horizontal drilling and reserves in the ground, increasing the recovery factors on other names. So I think it's important to show a company that's actually done it over the past, call it 6 to 12 months, and show you hard data that this actually works, what I'm projecting other companies to be doing. So there's a question here. Yeah, so this Google Doc is already shared. There's a link, again, on whitetundra.ca. If you scroll to the bottom under files, the first link on the left, I believe, is a Google Doc, and it has the template along with the data table. The data table being the automation part of it that automates strip pricing and exchange rates and all this. And basically you will need your own Google account, and then you can make a copy of it and basically work on it however you want. So it is out there. There are some issues with Google Docs. I did get one email about something, but I'll save that for later. So yeah, Crescent Point, production, 132,000 BOEs per day. This is Q1. It's the latest information we have. Q2s are going to be coming out next couple of weeks, 2 to 3 weeks. So we'll update every single company along with the price targets spreadsheet on the website. But right now we have Q1 to work with. It's a little bit delayed, but it kind of gives us an opportunity to look at these companies now before the results come out and make some good assumptions as to what the results are going to be. So 83% liquids, again, all from the MD&A or the financial reports or the corporate presentation. Those are pretty much the only three things that I use. And we want to break the production down. So we have light oil production and NGL production. We always want to break them down because each oil, each liquid, and the gas gets a different netback, different revenue on it. So we always want to break it down. Shares outstanding, again, basically just shares outstanding in million. As the spreadsheet kind of goes on, I do want to share these automated versions where the share outstanding actually updates real time as the company buys back shares. So I've got it working for my Google Doc here, but not yet for the template yet. So it's coming. Same with the share price. We just put it in as is. The current debt would be the net debt that the company puts out at the end of the quarter. So on the Q1 MD&A, Crescent Point said it was about $1.8 billion. We just put that in as is. Again, a lot of the explanations on this, I'm just going to leave it for now. Please have a look at the previous recordings if you want more information on what all this means and what I'm doing here. The annual dividend as well, it's been boosted again to 32 cents a year. That is the fourth boost that Crescent Point has done already in the last 12 months, I want to say. So definitely something has changed in their strategy from when I talked to them in February, March, where it was this super conservative company. They did not want to talk about macro. They, $100 WTI was like a swear word to them. Now all of a sudden they've gone completely 180 and started increasing dividends. And I'll talk about some of the other things they've done as well that kind of shocking. But yeah, and then we have adjusted funds flow, free cash flow, same. This is the exact same as all the previous companies we've discussed. I've adjusted the free cash flow again to adjust for the capital spend that changes quarter to quarter, especially in the Duvernay, where I will talk about that as well here later on in the Whitecap section. Hedging impact, WTI, everything is the exact same. And Crescent Point is one that more and more is getting super undervalued. I think there was a time there when you could make a case that Crescent Point with its hedges, etc., was maybe overvalued. But we look at the free cash flow yield at strip, 23.2%. So about double what the free cash flow times 8 model looks for. We get a fair share price of $18.72 at strip on this one. At $100 WTI, we get $26.10. So not only is the current price less than half of what the model puts out at strip, the upside torque is really, really good on this company because of their high liquids content. About 83%, I believe, is liquids. So as the price increases with their low debt number, the share price has that much torque built in. And just the scale of the company, they have about 110,000 liquids production. So I don't really want to go through the model again. Once again, I think people who are watching this understand this model now based on what I've discussed in the previous seminars. So if you're joining us for the first time, there's about 20 videos, 15 to 20 videos now that explain everything in detail. If you want more information. And then the upside case, WTI at 120, we have a fair share price of 39, almost $40 a share. So a 5x potential. And recently, when people ask me what's going on in oil, we've seen this big drawdown. What are you thinking? What are you doing? I think the way I run my investments, I always look for skewed risk-reward scenarios. And when I see something like this, where WTI just has to go back to its $100 range it's been in for the last 6 months, and I have roughly a 3x on the horizon. And then my downside on the other side is pretty limited, you could say, even at something like $80 oil, which I don't think we're going to get there, but a lot of people want to put those scenarios into their model. The risk reward, when the risk reward is so skewed, that's when I look at buying in. I look at the opportunity that presents itself and kind of make that investment decision. Once again, this is not investment advice. Please do your own due diligence. This is one model that I use that has been used pretty extensively in the past for the sector. And you don't have to use an 8 model. You can use a free cash flow times 6 model. And again, I've discussed how to do that in the previous seminars. Once again, we put the hedging in. So for those that know Crescent Point, one of the big issues here is their hedging. Majority of their barrels are hedged at pretty low pricing in the $65 to $70 WTI range, and just killing them. The one thing that maybe people don't think about, or that I haven't discussed as much as I should, is that when you hedge more than half your production or half your production, you're still paying royalties on the unhedged barrel. So if you're paying 30% royalty on a barrel and WTI in Canadian is $130, 30% of that, you're paying $40 a barrel in royalty. And if you're hedged at $84, by the time you take the hedging, the royalty, the operating cost, the cost to drill the wells, etc., off the table. Some of these barrels, it's like a double whammy effect, where not only are they losing money because they're hedged wrong, they actually get whacked because all the royalties they pay are on the unhedged price. So just keep that in mind with companies that are excessively hedged. I would say more than 40%. It can create a huge negative impact kind of going forward, which we see here at 120 WTI, there's almost $1 billion of hedging loss in just 1 year. So that's more than their entire capital program for the year. I'm definitely not, don't want to be the person who decided on these hedging numbers. But so we take into account the hedging, we put the production growth back in. You may notice the model has not been adjusted for the asset sale that they just did. Once Q2 comes out, I said, look, I got to adjust the whole model after Q2 anyway, in a week or two. So I'll just wait and get the whole thing adjusted. At that point, the sale wasn't big enough to be really impactful on the metrics anyway. So it got left as is. So yeah, after hedging, we have our fair share price at strip oil, strip gas, $14.36 at $100 WTI, $18.63. And you can just see the impact that the poor hedging is making from the unhedged number to the hedged number. We've lost about $8 a share of value just in the hedging at $100 WTI. And if you know my investment style, I really love these sorts of scenarios where you can front run the hedges dropping off. With Crescent Point, maybe a little too early because they still have significant hedging for Q3 and Q4, about 40,000 barrels every quarter. But this one fits really well with my investment style, especially after they've done a full 180 on their messaging and their mandate. Could be one that I would be looking to add potentially down the road here as things go. So before I begin this section, I want to again say, I know there's a few people who joined the Twitter call. If you want to join for the visuals, Zoom link, whitetundra.ca. Scroll to the bottom under events. There's a Zoom link, and you can join in for the visuals as well. If not, the Twitter space works just fine. So yeah, the exact same spreadsheet again. We put the capital program in. We put other FCF sources. So what I've been more and more putting in here recently is the interest savings. So if Crescent Point pays back $1 billion of debt in 2022, and they save, call it 5% interest on it, that's an extra $50 million that is getting added to the free cash flow this year, partly this year, and then into next year. So, for this company, $50 million, not a big deal, but it just adds to the accuracy. It's not that hard to calculate how much debt they're paying back. A lot of companies make it pretty clear what they're doing. And then if you want, you can run the model all the way to 2023. But I've chosen not to, just because it's more of a short-term investment here, possibly. So that's the model. And I'm kind of going to stick with this model, I think, for quite a while now. It's simple, it works, and it's able to differentiate the relative valuations between the companies that I track, try and find the best ones right off the bat before I go too deep into them. But more on the inside part of things. So this is the Viking asset that Crescent Point just sold to Saturn Oil. And the point I want to make here is look at what they're doing. They have these old assets with very little drilling locations left, very little upside in terms of production growth, in terms of where they can take this field, and they're selling this sort of stuff. They call it non-core, but basically what they're trying to say is we can't grow production. We're basically producing this into decline. The operating costs are going up. the water injection cost is going up, the drilling cost is going up. It's just not a good field. And the way you kind of, or the way I kind of look at this is each of these yellow boxes would be one section of land that the company has rights to. And look at all the land in the core of the Viking Trend. You can't even see the yellow anymore because it's so filled up with wells and there's nowhere left to drill. And then there's this land, open land outside the Viking Trend, which is basically useless because there's no oil there. The oil pools are clearly visible here based on the industry drilling activity. We have the Plato pool, the Herschel pool, the Kindersley area, kind of where the wells are. And props to Crescent Point for getting rid of this asset because there's just not much upside here for a small company that wants to do optimizations, that wants to do infill drilling. It's a great little project. They can spend a lot of time on it, really give it the love it needs, the focus it needs. Whereas for a Crescent Point, it's just too small to matter. So they got rid of this and they got into the Duvernay, which this part of their Duvernay is pretty filled up, but you can see all this blank land that's got probably 10, 15, 20 years of inventory here. They can grow production. They can keep about 35,000 BOEs a day flat in this part of the Duvernay. And they still have the, other areas here. Look at how many wells people are jamming into these sections now. It's just crazy. Like this part here, there's like 15 wells here in this area. So just extrapolate this to this acreage. And if they drill 15 wells a year, you can kind of visualize almost 15 to 20 years of inventory here in the Duvernay asset. Can they make it work? We'll really find out here. I was very, very bullish on the Kaybob Duvernay, Crescent Point's Duvernay, after they came out with messaging about the insane rates they're getting, the lowering of the drilling time, et cetera. But the rates weren't that great. Like they were good wells, they were good Duvernay wells. It was nothing groundbreaking that would cause me to look at a company just for that. So that kind of pumped the brakes a bit. I had some options, Crescent Point options earlier in the year. Once those were done, I never got back. But potentially one that I think a lot of people are looking at right now. I know they're marketing aggressively in the US-based funds and equity, along with the Canadian side, of course, which is continuous. So definitely want to watch for the funds flow rolling in and how things go here. Some of the other assets, so Shaunavon, all this stuff is happening behind the scenes. This next thing that I'm about to talk about, it's just stuff that happens behind the scenes that nobody really talks about. And then sometimes they just hit a banger of a well and a whole new field or a whole new zone is discovered. It's kind of like the Clearwater in a way, where nothing was happening, and then bang, the multilateral came in, the oil-based drilling muds came in, and it just completely changed the reservoir. So the Shaunavon Reservoir near Swift Current, so near the border, I believe, they've got wells that made over 5 million barrels each, vertical wells that made over 5 million barrels each, like 70-year-old wells. Some of them are still producing. So a prolific conventional reservoir. Canada has a few of these. And once again, look at the development. It's all vertical wells, very little injector support. These would be the injectors here, this symbol. The black dots are the active wells, and then these are the suspended wells. So you've got wells that made 5 million barrels vertically. Crescent Point went in and drilled 3 horizontals last year in June, and they all turned out to be duds. So what happened? We don't know exactly what happened, but it shows that Crescent Point is going in and trying to further add recovery factor in these old conventional tanks in the ground. And for whatever reason, these 3 wells have not worked out so far. that doesn't mean they're not going to work out in the future. So when you have reservoirs with high original oil in place that have been drilled only vertically, the recovery factors can be quite low, especially if you don't have the right water flooding support. And horizontals are just the best way to access more of the reservoir. And potentially one, if I got a chance to talk to, or if I talk to the VP engineering or the team again, I will bring up these wells and say, look, what happened here? Are you able to share any more information as to what your plans are here? Because one or two or three of these wells in the future could make millions of barrels, and not in 70 years, but in 5 years or in 7 years or in 10 years. So keep an eye out for these upside. Crescent Point has a lot of these old reservoirs that they haven't really done anything with, because 2014 onwards, we didn't have the money to really capitalize the money required into these kind of EOR plays. And before 2014, we didn't have the horizontal geosteering technology to accurately drill horizontally into some of these zones, especially the very, very thin zones where it would be very easy to get the drill bit out of the zone and then have water issues, sand issues, all kinds of other problems that nobody wanted to deal with. So yeah, this was quite interesting to me to find out. And capital return to shareholders, 4 dividend increases already. And based on what the trend is looking like, as some of the hedges roll off, as the pricing gets better or stabilizes, the free cash flow is just getting more and more. And I think Crescent Point had a capital heavy program for Q1 and Q2. So there's more free cash flow in Q3 and Q4 to give out. Are there going to be more dividend increases? I think, when the dividend for a company like Crescent Point is at 3.5%, 4%, 5%, for them to come out with an increase of 10% every quarter, it's not a big deal. I think it's definitely doable. For them to raise it from 5 to 5.5% to 6% over the course of 6 months, it really should be expected when these companies are making 10, 15, 20, 25% free cash flow yields. So I do expect to see further increases with the way CPG has been going about things. And it's great because the day they came out with their last dividend increase, the stock was up 15%. So people are paying attention, but they want longevity. They want stability. They want to see quarter after quarter of operational performance, of success, of the dividend continually being increased and no shocks to the market. So watching this closely as well, the news flow around these things, and are they going to end up increasing the dividend every quarter, which would be a big boost, not just to Crescent Point, but to the entire industry in general, and people supporting the whole cash return to shareholder plan and seeing people walk the walk. So a little bit on the budget. I like when companies put out pie charts like this because it tells you which assets they're focusing on and which assets are more mature, which assets are growth assets. So we see Southwest Saskatchewan, 19% of production, it gets 19% of CapEx. Makes sense. If we look at Southeast Saskatchewan, it's 34% of production, but only getting 26% of the CapEx. So more of a mature play, maybe it doesn't compete on economics, maybe it's already kind of tapped out. We can figure these things out once we have the main information. And North Dakota, this was really interesting. Only 14% of their production is in North Dakota, but they're spending 27% of the CapEx in this area. So what's going on? Is Crescent Point seeing something in the Bakken that is being missed? Further down here, I'll share some more information on that. This was probably the most shocking thing I saw, that Crescent Point has now put $100 WTI in their corporate presentation. It says US $100 WTI, hallelujah. after we've been screaming about these things for 6 months, maybe more. So, it's great to see. And yeah, we're below 100 WTI right now, but the macro where it's going, I think it's important for companies to start reflecting that and kind of giving that confidence rather than putting 60 or 45. And then you send it to a new investor and they're like, well, where's the $100 WTI you told me? So it's great to see it finally in the presentations, accurately reflecting what the company can do. And this is with the really, really bad hedges. So that's maybe one thing that these companies should now start doing is show the impact in 2023 with the block for the hedges rolling off and kind of make that point more clear. But it's a good start. So we'll leave it be for now. Tax pools, $10 billion of tax pools. They've got one of the most tax pools in the industry. And, potentially one of the reasons that they're actively capitalizing North Dakota is to make use of these US net operating losses, which when I last talked to management, they said this was the same as an NCL in Canada. So it's basically can be used against anything. And they're thinking, okay, well, if we can grow production a bit there or spend some money there, we're not paying tax on it anyway. So it might compete more for economics, even though the wells are not as good. Just me thinking out loud, the way that I'm kind of thinking how they're doing things. Because if they didn't do this, these pools would just stay here forever. With the US only being 14% of their production now, it would take forever to utilize these pools. Okay, so back to the Duvernay a bit. They do say they beat the type well by this margin here, whatever the margin is. But it's not that impressive because for two reasons. One, they were initially talking about it as if they were drilling like 40, 50, 60% better wells. And I just don't see that to be the case so far. And the second thing, we've seen this before, a lot of companies are not producing these wells properly. They jack up the production rate for the first 30, 60, 90 days, and then the well falls flat on its face after that standpoint. So it's too early to tell what's going to happen here. If they can keep producing more than the type well by this margin here, I think the wells are going to be pretty good wells. But if they start falling and declining at a harder rate because of the way they've been drilled and produced, maybe it's something to watch that it's yet another company that have front loaded the production and then the declines are just killing them on the back end. But too early to tell. So a couple things here, a couple questions. How far in advance do you think CPG will decide and then announce hedging program? So they've already put on hedges for 2023. So Q1, we have about 20,000 barrels have already been hedged at 105 Canadian. So not bad, not great. But I think that's what they're going to do. As the quarters go on, they're just going to hedge 25%. So about 20 to 25,000 barrels and just keep it rolling into whatever the strip backwardation is, which really sucks at a time like this when the strip is so backwardated. But if that's the way they want to do things, then that's the way they're going to do things. These big companies, they don't change their policy too aggressively, which is why I'm surprised how much it's changed in the last 6 months. Okay, so there's another comment here about Bakken is a waste of money and time. The plan is to sell and they're proving it up first. Yeah, for sure. There's been some sales in the Bakken recently where you got a question like, what's going on? Why are people going back into the Bakken? But possibly that's their plan. They did sell the Utica, I believe, assets. No, Uinta Basin assets in 2019, I want to say, in the US. So maybe that's their plan, is to get out of the US entirely by just making it look good, and then bang, it's gone. I haven't seen it on any teasers yet though. So keeping an eye. The other thing on the Duvernay I want to bring up is the lag time. These 3 wells just came online in May and they were spud in November. So compared to the Montney and some of the other developments, some of the conventional stuff, this is very, very long lead drilling. The Duvernay is not easy. You got to go in and build pads in the middle of nowhere with slopes and hilly bushes, or treed up mountains, I should say. So it's taken them 5-7 months to get these wells on production. And the reason I bring that up is because inflation hasn't hit. So when they were drilling back in November, fracking in March, April, the inflation wasn't as bad as they're going to see going forward. And why is that important? Because these are $10, $12 million wells. If you add in a 20, 30% inflation, that's like $2 to $3 million a well that's getting added on to the budget, and seriously affects the economics on these Duvernay wells. So keeping a very close eye on cost inflation in the Duvernay, definitely one to watch for as things go on here, as the supply chain doesn't seem to be easing up. And we'll see how many more they drill here and what it ends up costing them, because so far they've been talking about, oh, we can drill cheaper, we can frack cheaper, it's everything is cheap. Well, we'll find out if that was just a 6-month thing or they can keep it sustained. Okay, so the next thing, I talked about the Shaunavon project, these 3 drills that they did and how it kind of slipped under the radar. So they basically made it clear in the last quarterly presentation, I believe, they said, we plan to allocate 15% of our annual budget to long-term projects. So that's decline mitigation, that's environmental initiatives, so flaring less, venting less, using more of the gas, spill reduction, etc. And they have water flood conversions, polymer projects, and CO2 sequestration in Saskatchewan. So 15% of their budget, that's about $120 million a year that goes into these sorts of things. And all they need is 1 or 2 or 3 wells to hit something good. And all of a sudden they have a brand new field. They have more reserves. They have a higher recovery factor, extra reserves that nobody is really putting into the net asset values so far. And something to really, really watch for, because old fields with 5 to 7% recovery factors can get as much as 30, 40% with a water flood plus CO2/polymer flood. Huge reserve increases. It's going to take time. It's not going to happen overnight. The reserve evaluators are not going to give them credit overnight. So it's going to take time. And it's about, if you're somebody interested in these sorts of things, possibly look deeper into them, how the polymer floods are going, how the CO2 floods are going, and you can kind of almost, I hate using the word front run, but that's really what it is. You're front running what the public or the analysts have not taken the time to look at these assets, look at the reservoirs, look at the operations, and look at what's happening. So this map, I really like this map. So the yellow/orange is the Crescent Point land in Southeast Saskatchewan, where they say they're doing CO2 recovery pilots. And the red is the Whitecap Weyburn field, the most successful CO2 sequestration in the world. This red blob right here, especially is Weyburn. Cardinal's Midale CO2 field, another prolific CO2 enhanced recovery, is right in the middle, right here. And look at where Crescent Point's land is. They basically own a lot of adjacent land. There's already a CO2 pipeline coming in, and there's more and more sources of CO2 as the Saskatchewan industry builds up, whether it's potash, whether it's uranium, whether it's oil, helium. There's just more and more processing plants coming online and more CO2 availability. So this could be where the CO2 renaissance really happens. And there's only a few companies in this area. It's very concentrated with the major players, along with very, very small family-run companies. So definitely watching this very closely. I am hyper bullish on CO2 injection and enhanced recovery. It works. It's been proven to work. And it has the positive ESG profile / possibly federal funding credits that can really accelerate these sorts of projects. And on a global oil demand supply balance, it doesn't really make a huge difference. But on a localized company balance, you could 2, 3, 4x your company production from that asset if a CO2 pilot ends up working out. Hedging, so I've talked about the hedging, not looking good. I see they have Q2 2023 hedges too now. So $121 ceiling on Canadian WTI, pretty decent. That's about 95-ish US WTI. So, people are probably comfortable with this, and it's probably a good sign anyway, because if you have your base dividend hedged, if you have your share buyback hedged, people have more clarity, they have more confidence that you're going to go through with your return to shareholder plan as things kind of go on, and you have this 20-30% hedged. We'll take it. It does the job. It gets more people interested that want that downside protection, and that's all you can really ask for. The floor on this is $108 Canadian, which is really good, really good. Yeah, they must have hedged this right at the top, especially with the backwardation we're seeing. This one, so for shareholders of Whitecap, you will see this picture and freak out. It shows a $2.3 billion credit facility with a 3-year maturity, and it's 100% undrawn. And that's pretty much exactly what Whitecap had. And they used it to make the XTO acquisition, a $1.9 billion acquisition. What is it there for? We could pretty much speculate all day. Basically, they've had this facility for a while. They just paid it off using free cash flow, but it's sitting there. And if you're into M&A, you want CPG to go out and make a huge acquisition, you probably like this. But for the majority of the people who are not into acquisitions, the market is not rewarding acquisitions. Yeah, maybe one that management should be questioned on what their plan is here. With that much money sitting at their fingertips, Crescent Point being a notorious M&A company, they've bought God knows how many companies over the last 10, 15 years. Definitely one that I would ask management what their plan is with this. And if they're not going to use it, just get rid of it. There's no reason to keep extra credit capacity, especially the bank credit facilities. And it just creates unnecessary confusion for investors who have been slammed in 2014 and whatnot. Senior note maturity schedule. So they've got some 2023 notes. It would be nice if they can get rid of these and kind of move them further down. Again, it doesn't really mean anything right now, but when there's big funds, when there's banks, when there's institutions looking at these companies, they don't want to see this. They don't want to see you have debt coming due in 2023, 2024, and 2025. Some of these banks got hammered in 2014 because debt came due at the wrong time, and all of a sudden the company went insolvent when it was running just fine 6 months ago. So this is another thing I would be expecting from this management team, is to redo these notes, put them further into the future, or just pay them off entirely and just get rid of them. So another thing to watch for, ARO. So people know my stance on ARO. I think it's great. Definitely something that gets way too much panic around it. And this is a great representation of that. So Crescent Point's plan is to reduce their inactive well inventory, so basically suspended wells, by 30% by 2031. So that's all they're doing. They're reducing their inventory 30% in 10 years, roughly 3% a year of that ARO number, this massive number that freaks out people, they're only committing to 3% of that every year for the next 10 years. So, people saying the AER is going to come in and start forcing people to reduce inactive wells and whatnot. There's no proof of any of this so far. And this is the first time I've seen somebody project 10 years into the future and say, oh, we're only going to do this and that's going to be fine. So again, ARO to me, not a concern. I don't even think about it. If I see a lot of ARO, I look at which wells can be reactivated and which ones can we make money from, as opposed to a strict liability, if you will. And I actually saw, I'm going to kind of digress here, but I kind of saw a post on Twitter the other day talking about vehicles and showed this old Toyota truck that was selling for $4,000 like 6 years ago. Now it's selling for $15,000. So times change. Inactive wells are the same thing. They could be a liability at one point, and then they become an asset when the markets change, when the economics change, and when the industry changes to looking at things a different way. The Bakken. So Greg made a comment about the Bakken being a waste of time. So I have no idea what they're doing in the Bakken. Like, these are the wells that were just completed last week. And Crescent Point's well in the Bakken came on at 253 barrels per day for probably a $5, $6, $7 million well. I haven't looked into it deeply, so don't quote me on that, but this well is never going to pay out. It's not even going to make enough money to pay out what it costs to drill. We look at Crescent Point's Bakken to begin with, is not that great. Their 2021 wells are significantly underperforming the 2018s in dark green here. You can kind of barely see it. Even the 2019s and 2020s in orange, by this point, were better wells. So I don't know what they're doing in the Bakken and why there's so much money being spent in the Bakken. Definitely one that's going to come up in my next conversation as to what the plan is. And they're probably not going to give me a straight answer, but all we can do is try. So yeah, so that's a little bit of insight into Crescent Point's kind of acreage, what they're doing, their different areas. Watch the Duvernay, watch the well results, the cost inflation, watch the old conventional reservoirs. They seem to be doing these projects behind the scenes. They never talk about them, but all they need is one of them to really hit, and they could have a pretty big pool here to grow. Yeah. Is there any questions on Crescent Point before I go to Whitecap from the Zoom call? No. Okay. Right on. I just want to say again, for anyone that joined the Twitter space late and you want to join for the Zoom visuals, please whitetundra.ca, scroll to the bottom under events. There's a link, and you can get onto the visuals. It's also recorded and will be posted later. So we'll move on to Whitecap. So again, run through this very, very quick. 133,000 BOE. Look at how close it is to what Crescent Point's making. It's like 100 BOEs off. That's how close these companies are and have been. Liquids percentage a little bit lower, about 10 points lower than Crescent Point, more gassy, a little bit more shares outstanding. I believe, yep. About the same share price, debt. This debt number again is not correct because I haven't adjusted this for the XTO acquisition. We will do that as soon as Q2 is released on the 28th, I believe, for Whitecap. A little bit of a higher dividend, funds flow, cash flow, hedging, everything else is the exact same. And we basically get, at strip pricing, we get $16.73 a share. We go back to Crescent Point, it was $18.72, a little bit higher. $100 WTI, $22.78, $120 WTI, we have $33.66 a share on this. Hedging, again, we put the same hedging in, Whitecap also has some gas hedging, so we've thrown that in there. I haven't put anything in for production growth. Just too much going on right now. Once the Q2 results are out, we can make a much better analysis. I think Whitecap's also done some acquisitions, small acquisitions behind the scenes that they haven't disclosed. So potentially these come out, we get a little bit of a better understanding to what's going on in real time and their latest production targets for the year and into 2023. So after the impact of hedging, strip pricing, we have $15.12 a share on the model. $100 WTI, we have 20.23. So about a 125%, 140% increase from where we are today. And we put the capital program in, other FCF sources. This was before the acquisition for the debt pay down. No longer the case. This is probably going to go up by 40 million with the debt they added, maybe even more than that, possibly. So let's get right into it, the acquisition. So all debt. We need to understand it's all debt. When we buy companies, we buy shares. And as equity holders, when a company makes acquisitions using debt, it gives us additional torque into the future, assuming the acquisition makes sense to begin with. But it gives us more and more torque as equity holders into the future because you're getting more funds flow per share, free funds flow per share, production per share, net asset value per share, acreage per share, whatever. You're just getting more. Unfortunately, it comes with a time lag. So a lot of people don't want to wait for the acquisition to close and be properly capitalized and kind of show its true spirit. And a lot of people leave the shares. So when I look at Whitecap, I'm looking at a 2 to 3 to 5 year story here. This is not going to be a right now, we're going to get full credit for this acquisition right now kind of thing. It's just not going to happen because to build reserves, you need to drill. And I'll talk about here how they can't just ramp up drilling in the acquisition areas. They're way in the bush. There's basically jungle with grizzly bears and ice, snow that piles up 12 feet high when the wind drifts the right way on the roads. It's pretty aggressive area. And one of the biggest issues I had with the package that XTO had for sale, it constantly got brought up. What a rough acreage this is. Hills and mountains and lakes and streams and swamp, trees all over the place. Initial thoughts, as an equity holder, as a long-term equity holder, this is something that people should be very happy with. Again, just my opinion, not investment advice, but I'm really a fan of this acquisition. It was the last big undelineated reserve acreage left out there. The market in the Montney is going to heat up. Same with the Duvernay. We've already seen transaction values go up as the bull cycle progresses. There's only so many companies out there, and they're not going to sell. If you go in and try and make a lowball offer on some of these companies, they're just not going to sell. They say, well, we can just continue producing. We'll pay out dividends. We'll do share buybacks. Why should we sell? We're in no rush. We have low debt. The macro outlook's looking good. And there's very few private companies in the Montney. So compared to some of the other old conventional stuff out there, there's very few private companies left. Maybe Hammerhead would really be your only one of significant scale that's still left here. So I think the market's definitely going to heat up. When you look at the price that Whitecap paid, people are saying they overpaid. Well, they didn't overpay because they wanted to. They overpaid, if you think they overpaid, to win the bidding war. There was a lot of people interested in this package, including, I've heard rumors, some of the big US independent companies were looking at this because for them, this represents if their Permian is getting flattened, they can no longer grow the Permian. This represents a really, really good growth acreage with future potential built in for many, many years. So I kind of have been thinking about it this way, is Whitecap had to overpay because of the quality of the acreage. And I'm pretty happy with that because I know that this thing got into a bidding war, and the top bidder wins, which sometimes comes across as overpayment. Natural gas plants, so something that I try to focus on more and more is these plants are not cheap. When you have a BCF of raw gas capacity, you're talking over $1 billion of capital that's been put in here, maybe even higher than that, given where these plants are located. And they're sitting less than 50% full. So great for two reasons. One, the takeaway capacity is already there. They don't need to build it out. There's some pipelines, it doesn't really cover a lot of the acreage, but it's there. They can find ways to snap onto it, connect onto it. But secondly, if you have a gas plant that's running at 40% capacity, you're still paying the operator, you're still paying the lease cleanage fees, the power cost, the camp maintenance, the ATVs, the yearly checks, everything. When we start ramping up the capacity of these plants and make 70, 80, 90% full, our fixed costs don't go up. You're still paying the same operator. You're still paying the same for cleaning out the lease. You're still paying the same for the yearly checks. You got to check everything, whether it's running or not. So watch for the operating costs to go down in this area as the plants get ramped up, as the production increases. You get a lot of synergies when you have this sort of scenario occur with gas plants at lower capacity. This is not the case for the rest of the Montney. The upper Montney, more north of this, is completely filled to the point where they're having to shut down production. Pipestone just came out with a production decrease because they can't find processing capacity. This is a really, really good bonus. And they've got a lot of capacity here. They've got half a BCF of capacity. Pretty major growth plans can be developed here without worrying about this. So I talked about the Montney and the Duvernay being in the middle of nowhere. And here's some pictures. Pictures speak 1,000 words. It's literally in the bush. Permafrost areas. You can't just go in and build these anytime. You have to wait till the ground thaws. And you also got to wait so it's not a full-on mud swamp either. So there's a timing issue. This is the satellite view from Google. You can see all we have here is oil wells. That's it. So these little square boxes, tiny boxes, are the oil wells. And, we don't see any settlements, any towns. There's literally nothing here except bush. You can see how densely treed it is. And here's one of the camps. I believe this was the Rest Haven camp. Look at where they've built it. It's basically where nobody would want to really go. Middle of jungle, and it's tough terrain. It's up and down. This picture on the right, you can see where they're drilling. Basically got to go in, flatten out the land, build the lease, clear out the trees, make sure there's no water issues with swamp, and then you can finally drill. So pretty gorgeous scenery and land, not so much for oil drilling. So just expect a little bit higher cost is where I'm trying to get to as they build this out. Them being the first movers, they're going to have to pay extra to build some of this infrastructure out there. The Duvernay side, not really a huge fan of the Duvernay. High decline, very high decline asset. And it's going to be difficult for them to sustain this at 21,000 BOEs. They can't really grow it. It's a pretty tapped out asset where it is. So it's more the Montney that they bought it for. You can see the acreage size is much bigger, whereas the Duvernay side, smaller. There's only one gas plant. They own it, so that's a bonus. But 60% utilized, not that much space in here. Another 50 MCF, possibly. Lots of wells already drilled. And look at the decline rates. So if we go back to 2020, it declined from 148 million of gas to 112 in 8 months. So about a 30% decline, roughly 25% decline in 8 months on the overall gas production. On the condensate production, it went from 9,000 to 4,800. So almost a 45% decline in condensate production in less than a year. These Duvernay wells are high decline, up to 85 to 90% decline in year one. So basically, you better hope that when you make a decision to drill this, we know from Crescent Point's wells, it takes 7 to 9 months to get them on production. You better hope that the oil market is good for the first 3 months that you bring these wells on production, because that's when they're going to make the bulk of their money. And if there's a mistiming to that, like right now, if somebody was bringing on a well right now into a $90 environment versus 115, the economics on Duvernay well drastically change. And definitely less visibility on what's going on. And then recently, something interesting has happened where from the end of 2021 to April of this year, the gas production doubled and the oil production tripled. Now, this is not all Whitecap volumes. There's a lot of third-party volume involved here. So somebody else could be bringing on wells. But look at May. Production dropped by more than 90% on both oil and gas. So could it be just a turnaround? Maybe. Or did XTO shut in these assets before they sold them? And now there's a flush production bonus here. I don't have the answer. Something I would have to ask management or investor relations. What happened in May that the production completely fell off a cliff? And was it shut in for a reason, for a sale? And now Whitecap's going to get the benefit of this flush production coming online. Again, questions that just come up. I don't have the answer yet, unfortunately, but I will get the answer and figure out. It could have just been a maintenance on the gas plant, something simple, but still worth looking into given what's going to happen here. CACWA results. So this is something that applies to the entire unconventional well industry. So Permian, Eagle Ford, Duvernay, Montney, whatever. What we saw from 2016 onwards, let's say 2014 onwards, was jamming more wells in the same acreage, longer and longer laterals, and more frac proppant. That was the consistent trend year after year after year. They would go into 2 mile long wells and 3 mile long wells, 1 million tons of proppant, or 1 million pounds of proppant to 2 to 3. It just kept getting bigger and bigger, and the wells kept getting tighter and tighter. And now we're seeing it unwind. We're seeing reduced frac tonnage and more optimized well spacing. So this is their nice way of saying that, hey, look, we screwed up. We went too crazy. We got all horned up on these massive IP rates and whatnot. And we ended up realizing we're not producing these reservoirs properly. We're basically wasting a bunch of oil, and we're running into issues with gas production and production 6 months down the road, 12 months down the road. So it's not just Whitecap that's done this. There's many producers in the Permian and in the Montney that are also doing this. So just watch for this. This is going to affect quite a few things, from the well results potentially being better, the single well results, but also the well inventories are going to go down. If somebody said they can drill eight wells per pad, this many wells a section, it might actually go down. So you lose inventory and you lose the number of wells you had to drill. So watch for downward revisions in this. It's not going to happen right now. Companies are going to fight tooth and nail to make it not happen. But it's going to happen. That's just the way reserves calculations work. So it was mentioned yesterday on one of the Twitter spaces about the IRRs that are being put out. So tier 1 wells in the Montney, Whitecap is claiming IRRs of greater than 500% at $81 WTI. Could be. They could be making 500% on individual wells, but that doesn't take into account what they paid for the acreage up front, what they're paying for the other development costs, the infrastructure, the pipelines, the transmission, any other gas processing required, liquids handling. It doesn't take into account any of that. So yeah, this IRR seems high, and you got to wonder, how come other companies didn't buy this? Well, because the IRR is getting more and more useless as things go on, especially with these Montney Duvernay wells where they decline 75 to 90% in the first year. Yeah, you pay out right away, but it doesn't really hold up over time to what they're trying to claim. That's not to say these aren't really, really good wells at $120 Canadian WTI. These are really, really good wells, but let's look at wells more in full cycle cost, not in a well cost, and get all excited as investors as well. It's important to keep things in perspective as to what's happening here. And this is the reason I mentioned this is exactly what fooled all the Permian funded private equity, or the private equity funding the Permian, the banks funding the Permian. They all got fooled by these massive IRR rates, not realizing that the company paid $40,000 an acre to buy the land, or that they need massive water disposal issues or sand issues or whatever else you want to call it. And more and more as this cycle goes on, I think banks are going to be more careful. Funds are going to be more careful looking at the full cycle cost. And it's important that we as investors try and get a full cycle cost, or just ask the company directly what's happening. Okay, the next thing on Whitecap would be the unbooked value. Again, I've talked about this a little bit before, and I like to keep mentioning it, that when you buy packages like this, you don't get any benefit to reserves from the evaluators if you haven't drilled a well in the area. So you could have 3D seismic, you could have adjacent wells that are just far enough away that show you're in the Montney trend. But unless you drill a well on that section or somewhere close, the reserve evaluators are not going to give you credit for it. So people look at these sorts of things and they say, oh, it's only 10 years of reserves. Yeah, 10 years of reserves so far. This is not a end-all be-all reserve calculation. As they drill more, they get more reserve booked, they get more well inventory, they delineate the land further. So the 10-year reserve becomes a 40, 50, 60-year reserve at current production rates. If you triple production, it still is a 20-year reserve. If you see the way I'm trying to calculate it, is at today's reserve, at today's production, if it's a 60-year reserve, if you triple production, it's now a 20-year reserve. And that's the way I look at these acquisitions. I don't look at what the booked reserve is, the consultant average and all this. The consultants are not paid to be right. They're paid to not be wrong, which means there's going to be an ultra conservative bias to the way they look at reserves, because they technically can't be wrong if they're way under and they just keep adjusting it as things go, as opposed to being aggressive and they could overplay their hand potentially. So I really like this chart. at $100 US WTI, $5 gigajoule gas, the unbooked value is over $9 billion for something they paid 1.7 to 1.9 for. Again, it's going to take time. I mentioned this earlier. This is not a 6-month story. This is a 2, 3, 5-year story for this value to get reflected in the price of the shares. As the production goes up, as the reserves go up, as they develop it, it's going to take time. For sure. This is a patience story. And if you're of the opinion that the macro outlook for oil looks great anyway, you're not worried about short-term dislocations. People keep screaming recession, recession. Well, what happens on the other side of the recession? There's not suddenly 3 million barrels of oil supply on the market. So you end up back in the same problem, the same supply issue we're in today, maybe even worse. And if you believe that thesis, you have time anyway to let these things play out and for the value to be reflected. Again, this is not investment advice. I hate to keep saying this, but I just want to be careful. This is the way that I look at these things. You may have different ways of looking at it, and I'm always open to discussion on these topics. Dividend. So the dividend went up 22% with the asset acquisition. It's expected to go up again once the debt hits 1.8 billion. And this is pretty interesting from them. They say the expected timing is Q4 2022. I think it's going to happen like early Q4. At these sorts of prices, they're almost sandbagging this by saying Q4 when they should hit this target pretty early in Q4, which is only 3 months away. And maybe something we need to focus more and more is we're already in Q3 and Q4 is 75 days away. And there's another 27 to 30% increase in the dividend coming. How is the market going to react to that? That would put them at a roughly 7% yield at today's share price. Seems pretty good walking the walk so far, and with much more to come as things kind of go on. The hedging, this is one where the hedging did drop off already. So from Q2 of 2022 to the second half of 2022, they're making an extra $200 million a year because the hedges dropped off. And some of the hedges are at higher pricing. So $200 million on a company, let's say what's the enterprise value today with the new acquisition is roughly $8 billion. So an extra $200 million basically pays for a 2.5% dividend just from the hedges rolling off. So it just gets better and better as these low price hedges roll off. There's more money, more free cash flow. Into 2023, the story gets even better. So I got lots of stuff here on them. This is the Torquay Three Forks asset. And just like Crescent Point, Whitecap has a lot of these old conventional reservoirs they've picked up over the years. These two companies are serial, notorious acquisition people. Like they just keep buying old companies, family-run companies, small juniors, and just keep growing whenever they can get deals. So there's a lot of upside on these conventional plays. And the Torquay asset is especially interesting to me because they have not drilled it. They've let the competitors around the area delineate the entire field. And meanwhile, their Three Forks and Torquay asset are just sitting there waiting to be drilled. And look at these wells. They come on pretty strong. They've added water injection support. And the wells have gone from making 1 barrel a day to 10 barrels a day. So as the water injectors come on, sorry, I'm on the wrong asset here. So that's Torquay, where we have the upside on the drilling. We also have these other assets in Saskatchewan, Alberta, all over the place. where they're just firing up waterflood. So the waterflood didn't get capitalized 2014 to 2020. They finally got the water flooding kind of started in 2018, 2019. These are our injectors. These are our producers. And we see some of these wells, this one that I've highlighted here, has gone from making 1 barrel, so it naturally declined all the way down to 1 barrel a day. It's now in less than 18 months, it's now making 10 barrels a day. So, you know, you might think, oh, that's only 9 barrels a day. It doesn't even really matter. Well, if you had a field making 1,000 barrels a day here combined between all these wells, and you can 10x production just by adding water flooding support, that's 9,000 barrels of low decline, high net back. You don't have to spend any capital. It's already there, production. And it's already built for the higher production rates because they used to produce at these rates 5, 7, 10 years ago. So water flooding, CO2, polymer, any new fields that are trying these, I'd like to keep an eye out on them, see what kind of production uptake they're getting, see what the decline rate mitigates to field wide, and see if they can sustain production. This is water flood is a 5 to 20 year story. So you just get these assets, you let them produce, create gobs of free cash flow for you that you then use to capitalize the Duvernay and the Montney and have these massive rates over there. It's a tried and tested method that people got way too aggressive on in the past. They started making too many acquisitions, got just way too much into it. Now they're taking things slow. They realize having a low decline conventional asset base that throws off free cash flow to support the unconventional activity is a really, really good business model that works quite well, even if you're a dividend payer and growing. Okay, so this is another well in the area. You can see the water flooding support has not reached it yet. So, you know, this water flood is still in its infancy stage. These two wells are not that far apart, but water flooding just works slow. It takes time. This is the Wapiti Cardium field that I used to operate for modern adjacent. Drive by these wells every single day. And why I want to bring this up is not just that, but something has changed in this field in the last year or two. So this is one of their newest wells. You can see how it doesn't decline. For being an unconventional Cardium well, it's not really declining. In fact, the production seems to be going up. And how can we verify this? Let's look at the wells. There's about 5 wells that came online in early 2020. In 2.5 years, they've produced about 100,000 barrels. Okay. There's also 5 or 6 wells that came online in early 2021. So a year later, they've only been producing for 1.5 years, and they're already producing 100,000 barrels, or they've already produced cumulative 100,000 barrels. So whatever Whitecap has done, not only has it accelerated the production, they've been able to sustain these production profiles for much, much longer. And Whitecap was running a gas injection pilot here back in 2020, in 2019, I believe, actually. And maybe they haven't disclosed the results properly of what this gas injection is doing. It's really helping these wells. Whitecap was also doing all kinds of engineering trials where they would move wells to pump jack, then to plunger, then free flow them, like all kinds of science experiments. And they seem to have figured out something that works. And again, this is not reflected in the reserves. This is not reflected in the capital efficiencies that people are modeling. And this is pretty significant information if they decide to kind of expand this field further. And this is Joffrey. So the last thing on Whitecap, Joffrey, east of Red Deer in Alberta. You know, people talk about Weyburn, Midale being CO2 floods, working really well. Whitecap just started a CO2 pilot at Joffrey. and pretty significant field. Lots of wells in this kind of like boomerang formation shape. What if it works? Whitecap knows CO2. They have deals with the government on CO2. They have deals with suppliers on CO2. And they're trying CO2 injection in new fields already. This is already happening. And I bet you there's not a single analyst or Whitecap shareholder out there that really is watching this closely. You know, if CO2 starts working in other fields that Whitecap already owns, they can basically transition their entire company into a CO2 injection company expertise and start utilizing it across their assets, along with taking over other assets and putting CO2 there. If you have the source of CO2 supply into a general area, you're basically the king of that area, because no one else is going to put up CO2 pilots and injection for low production or try and compete with you. So Whitecap definitely has a huge advantage in the CO2 injection, which again, people know I'm pretty damn bullish on CO2 being kind of the next thing for Canadian conventional reservoirs, and one to keep an eye on. I haven't seen any concrete results yet from Joffrey, but I'm definitely keeping an eye out and hope to share more in the future Whitecap seminars. Yeah, so that's that on Whitecap. Is there any questions again on the chat? If you have anything, please feel free to put it in. And if not, we'll continue on to Hemisphere and try and wrap this up here in the next 15, 20 minutes. Okay, so there's a question here. Thoughts on Whitecap's CapEx being so much lower than CPG? So there's a few components to that. I think the decline rate being a little bit lower on Whitecap, them having more of these water flooding, CO2 schemes helps. They also were not in the Duvernay or any heavy CapEx unconventional areas. So that helps. And the fact that they're 10% less liquids actually makes a huge difference, because it's just that much harder to keep liquids production flat or grow it compared to gas production. So if you're a company with 73% oil versus 83% oil, there's just going to be a built-in more CapEx required to keep production flat. So yeah, just kind of a combination of all that, I think accounts for the $200 to $300 million difference in CapEx. But with Whitecap now aggressively developing the Duvernay and the Montney, I think they end up being the same for 2023, around $1 billion in CapEx or so. So, but yeah, great question. So we'll move on to Hemisphere. Again, a pretty small company here. I don't want to spend too much time on it. It's one that's going to be for the niche investor. Talked about this before. I've written a Seeking Alpha article on this too. A very cool little company that's doing a polymer flood, and that's really all they care about. So again, I'm not going to go through the spreadsheet. I think people know this by now, but I'll go through fair share prices at strip 2.76, roughly a double. $100 WTI 399, 120 WTI 597. So huge upside torque built in. That's a 99.9% heavy oil play. They really don't produce anything else. Some hedges that are not that great, that are definitely affecting the share price. A little bit of growth I've put in. The polymer flood is working better than expected by a pretty significant margin. So even the growth I had put in May when I redid these, May or June, is now seems to be wrong and running below what this company can produce. So definitely watching the growth. When you have a company making 2,600 barrels a day and they can beat production by 20% with their operating costs not going up and not having to drill anymore, that's pretty pretty significant boost to the free cash flow profile of a company like this. So I'll just get to it. They recently expanded their CapEx as well. So keep an eye out for this. Junior companies expanding CapEx slightly, but still enough that it's adding a little bit of a growth wedge in there. So a company like this, if they grow production by 5% extra, that's only 130 barrels a day. It makes zero difference to oil supply demand anywhere, but to the company itself can add a little bit of bonus. So there's a comment here or a question here on Whitecap's share buyback. So not all that happy so far, but I think another block buyback is possibly coming here and will help support the share price along with the increased dividend and closing the acquisition. Other than that, the NCIB, I think, needs to be used more. Whitecap does not use it like at all. So they should definitely be using that more. And potentially, as a dividend increase. Okay, so I lost the Twitter space, unfortunately, but it's the way she goes. So sorry, I lost my train of thought here. So the Hemisphere hedges I'll talk about the hedges here as I kind of go per. So just the basics, I guess, to begin with. We have almost no debt. So this is going to appeal to the low debt investor. Very good insider ownership. So in the 12 to 15% range. Low share count. They have an active share buyback program already going on. The LMR is just crazy. Like they have very little liabilities, only $8 million undiscounted and 1.9 million discounted. So pretty low risk play as it gets in the oil markets. And when we look at production, I talk about production beating. They're already beating my Q1 estimate by 200 barrels a day. And the exit production is beating by 500 barrels a day. So almost a 20% beat on the production that I had initially estimated. But here's the problem. The adjusted funds flow isn't going up that much between the WTI numbers because they're so heavily hedged. And there's just some issues with this company that my model doesn't accurately reflect, where as the WTI price goes up, they can end up making less money because the royalty rate goes up at a higher percentage. So if you're an investor that's looking for a company that doesn't change much, in fact, very little, between 85 and 115 WTI, that's got low debt, that's got low ARO, that's got a actively involved management team, a insider ownership, no debt. This is the one for you. This is a company, I don't even know why it's public. It should be a privately run company with just paying out dividends in the 20 to 30% range every single year. It would run just fine. It doesn't need public equity. It doesn't need all this hassle of being a public entity. But hey, that's what it is. And we have a chance to buy in. So just want to put that out there. It's a very unique company that people just write off, but could meet certain investors' criterias. Very, very stable share price. It seems like. Reserves, 1P reserves at $100 WTI, $3.83 a share. At 70 WTI, it's still above what the price is trading at today. So low risk as it gets in the oil industry. This is all they have, really. The Atlee G pool and the Atlee F pool. A few wells, nothing too crazy. This is how it works. So, sorry. This is showing CO2, but basically put polymer in here instead. So they have this oil bank. They inject polymer, then water, then polymer, then water. And basically they have this oil bank that gets produced from the production well. To explain it a little bit better, this is how oil reservoirs are naturally when nobody has drilled into them. And when you produce them and then you put water flooding, this is what happens. You produce oil, but the oil sticking to the rocks has more of an affinity to stick to the rock than it has to flow into the production well. So what you do is you inject polymer or CO2 that basically pushes this part of the oil out of the reservoir. And this picture is not really doing it justice, but basically 90% of the oil gets left behind with regular production. And even after water flood, almost 75 to 80% of the oil gets left behind until you use polymer or CO2. So definitely a benefit to doing it, these sorts of recoveries. Hedging, there's a bunch of hedges rolling off on August 31st. So they sold calls, which means they gave another person the option to buy WTI at this pricing, which they're obviously going to exercise for, you know, significant part of the production. And these roll off on August 31st, actually, which not that far away. And for September, they have these put spreads, which are basically going to expire worthless. So it's not hedged. Same with September to December. There's these put spreads that are going to go unexercised, the way that I understand these hedges. Again, I've made mistakes on hedges recently because people are coming up with all these different structures, and sometimes it's hard to understand them, but these put spreads are going to expire worthless. This US call is not going to be exercised right now because the price is trading below 100. This three-way collar is basically the only hedges they really have left, because going into next year, this put spread again is not going to be exercised. They're basically unhedged into 2023. And as the production goes up and beats expectations, the percentage that they have hedged is lower and lower as well. So just keep that in mind. 800 barrels hedged on a 2,000 barrel company versus a 3,000 barrel company changes the equation quite a bit. They also have these WCS hedges. So they run to the end of the year. Not a huge volume, but it's at $13.80. WCS right now has weakened quite a bit, trading in the minus $20 range. So, you know, little bonus, I guess. Not that it really makes a huge difference, but I like to see companies win on hedging, whether it's by luck or whether it's planned. I think, you know, it's a confidence booster. It adds the financial benefit, and you almost get a win for all this other losing on hedging that oil investors have been doing for the last 2.5 years. No, year and a half, roughly now. The new wells that just came online in the F pool, really good wells. All 4 of them, pretty damn decent wells, like 50 to 70 barrels a day. They don't really decline. They're supported with water injection, I believe. Yep, there's some injectors in there. But you can see how the F pool is inferior to the G pool. The G pool wells are about 150, 120 barrel a day wells. The F pool wells are half that for the same price. So, you know, I can definitely see why they did the polymer flood on the G pool first, but the polymer flood is coming on the F pool along with some new drills. You know, it's just a small growth story doing its thing and walking the walk. In fact, not just walking the walk, they're like running the walk. They've beat expectations on just about everything so far. Some of the G pool wells, again, looking really solid. Came on in September, already produced 25,000 barrels. So pretty solid production, low decline. 2 wells I want to talk about in the G pool, particularly. One you see what happened when they converted to polymer flood. So the well was still making 60 barrels a day, and they shut it in and converted it to an injector and started injecting water into it. And you might wonder, why? Why would you shut in a well that's making 60 barrels a day, consistent with no decline? It's because what they're trying to do is push all the oil into certain wells. So we see this well here, which is right next to it, section 19, section 20. It went from making 100 barrels a day to making 300 barrels a day. So success, this is what success looks like. As a petroleum engineer, I just look at this and I shed a tear. You know, this is something that's worked over a 2-year period, 2 to 3 year period. They made the risk of shutting off producing wells, converting them to injectors, and it took them, you know, over a year to finally see the benefit of this. And that oil bank, as we see here, the oil bank come in to these wells and the higher production rates. So just amazing, you know, love this sort of engineering success. And now they're going to learn from this and use it on the rest of the G pool and the F pool. They're already beating expectations. How good can it get? G pool, this is about a 4-year period. I don't know where the dates went, but you know, you can see production slowly increasing. We had this initial bump. We had production loss when the wells got converted to injectors with the initial bump. And then now we're seeing the polymer flood slowly showing its true colors, increasing production. This is log scale, by the way. So this is almost a doubling of production in 6 months. And then we have the F pool, which this is our oil production on the bottom. We see, you know, they haven't done the polymer flood on the F pool yet. So there's all this upside, which is not reflected in the budget. It's not reflected in the free funds flow estimates. It's not budgeted in the capital plans, and it's not that expensive. Polymer flood is pretty cheap to put in. It doesn't cost that much. So yeah, Don Simmons at Hemisphere has been pretty vocal and transparent that they are going to run a polymer flood on the F pool, and it's not going to be as good as the G pool. Again, if a company goes from making 3,000 barrels to 4,000 or 4,500, and you're not paying for it, it's just basically free, it can make a huge impact to your investment in the company. So yeah, I'll leave it at that. I think I'll end it there. That's kind of all I had for these companies. So there's a question here. Is this similar to 10th Ave at Murray Lake? So I haven't looked at Murray Lake that closely, but it is a polymer flood. And they are increasing production. I believe almost doubling production this month, or it's already happened in June. So I don't have the latest data, Ken, on 10th Ave, but you're right. Yeah, it's similar. I also think Murray Lake might have more drilling potential, whereas these pools are relatively small. So you can't really just keep drilling. You have to almost buy something else, whereas Murray Lake might be different, but I don't want to make comments here without studying the asset in detail, and I will get back to you on that in one of the future sessions. Okay, so there's a question here on, when you're finished with Hemisphere, can you make some comments on the macro picture? Yeah, for sure. So I don't want to do the macro marathon sessions. I think I basically made my point clear on a lot of the stuff that I wanted to in the April session, but I do think a 30-minute to 1 hour update is coming. I'm thinking maybe next Saturday. I don't have anything planned for next Saturday right now, but maybe I could do a quick session. There's been kind of an issue here where a lot of events that I want to go to in California are Saturday mornings and afternoons. So I might adjust the schedule a bit, but it is coming, Mike. And some comments I can make right now is the physical market, I don't see any weakening. Some of the European blends, some of the African blends, Malaysian blends are trading at prices much higher than WTI. I think the SPR release is artificially holding back the heavy blends along with US and Canadian pricing. So that's going to continue. There's not really much we can do about that until the SPR release is done. On the macro side, I still think people are being way too relaxed. You know, the energy crisis and what's happening, people are just being way too relaxed as to what's happening here. They still keep pushing the agenda, the ESG agenda, but the supply issue is very, very tight. It's hinging on certain things working out. Like Libya now apparently is back online. That could go down any moment. Russia is using a lot of the tankers that Iran used to use to haul their illegal sanctioned crude. There's only so many tankers out there, and people are just not talking about these things. Kazakhstan, the port in Kazakhstan, Russia has a infinite, they basically said, we're going to look for mines forever, these World War II mines forever. And the one mine they did find, remember, this port exports 1.2 million barrels every single day, and it's under the control of Russia because it belongs, or it's on Russian land. The pipeline goes mostly through Russian land. So the one mine that they did find, they couldn't even retrieve it. They had to block off all the ships and go and blow it up in the water. And it's just like these sorts of things are just being taken so nonchalant. Russia, the Sakhalin-1, one of their flagship oil producers, is down from 400,000 barrels a day to 6,000. Nobody's talking about this. What's going on here? You know, ExxonMobil has said they're leaving Russia, while the field production has declined 98.5% in 3 months. It's not decline. There's something serious has gone wrong here, where nobody knows how to fix it, possibly with ExxonMobil's expertise and the service companies not being there. Nobody's talking about this. So it's just things that I see in the background where the recession narrative has just taken over, and the data just is not supporting any sort of massive demand destruction. People took 1 point of gasoline demand post July 4th, and they started extrapolating that to all sorts of theories. And I just find it fascinating the way things have gone in the past month. You know, like, think about it this way. If you're a gas station and the price of gasoline has fallen for 32 days in a row, and you're running a little bit dry from the July 4th weekend, are you going to be rushing out there to refill your tanks when you know the price is going to drop another 15 cents in the next week? Gas stations don't make that much margin anyway. 15 cents is massive to them. So when we look at things more and try and explain things, I think the real result comes out as to what's happening. The jet fuel picture still looks great. The inventories have built in China. I think people are also counting out China. China right now is using 2 million barrels a day less than it did even within COVID, when they were fully opened up within the COVID times. We're still 2 million barrels a day below that. Chinese international flights are down 95%. The big jet fuel using flights to China, Japan, Malaysia, they're still down anywhere between 75 to 95%. They're not going to be gone forever. They are going to come back. So to me, a lot of the risk I see in the price of oil is to the upside. And especially once the SPR runs out, there's no Band-Aid left. And what's going to happen? The bet right now globally is, by the time the SPR sales end, they're either going to see a supply response, or they're going to have massive demand destruction, and the prices will be okay the midterms will end, but gasoline will become less of a political tool. That's what they're betting on. Well, the supply response so far, not been good. American production is not looking good. The frac fleets have maxed out at 280 for the past like 3 to 4 months. The rig count is flat over the last month. The well quality is further degrading. And now that I say all this, I think maybe I should do a longer macro session to share some of the latest well quality results and all this. Oops. But that's kind of what I'm seeing on the macro. On the supply side, I'm following US NGL production pretty closely. It's up pretty significantly. I'm following US production that the EIA is putting out versus the actual production. There's a 200,000 to 300,000 barrel deviation that's now happening between these two. What else are we looking at? That's kind of it on the supply side. The inventories look pretty decent. For the jet fuel inventories are 33%, I believe, below last year, back to our pre-COVID levels. So I don't know how the airlines screwed up this badly. The jet fuel consumption increase for this summer was probably the most visible, most clear thing out there. And both the airlines and the airports screwed up, not figuring out what the demand was going to be. And you sometimes you got to wonder what's going on. Like, are people that bearish on oil demand that they're just literally don't understand what's going to happen? India still looks really good. Their consumption is hitting all-time highs. Their vehicle sales are hitting all-time highs. One of the big growth areas that I like to track. There's roughly 10 to 15 airports a year coming online in India. So more travel. And yeah, that's really it for now in the macro. Mike, if you have any specific things, I'd be happy to answer them more. But I could talk macro here 24/7. So yeah. Yeah, appreciate the question though. Thoughts on the current price of WTI and current volatility? Yeah, so maybe what I'll do is later today, I'll post this thing from Goldman that got put out about 2 months ago, talking about value at risk modeling and how the way the bank's models are set up is they literally cannot hold paper contracts once the price gets to a certain level and they just start dumping. So we're stuck in this certain range. But what has happened is, as we're stuck in this range, the number of contracts out there is just getting lower and lower and lower. So it's going to be volatile. I cannot sit here and tell you the volatility is going to be any better going forward. There's too many chefs in the kitchen. There's too much going on. There's too much job owning. There's way too much data out there, some contradicting each other. And there's too much lag time in the data. The data is not accurate enough to the point that it's definitely going to be volatile. The way that I look at it right now, not investment advice, the risk reward on oil in the mid 90s, I think is skewed pretty good to the upside. If I'm taking a bet on buying something at $90, $92 WTI, or stock when WTI is at 95 or even 97, I definitely think I'm getting the better end of the deal. And this is the other thing that I think is going to happen is if the price of oil falls below 90, call it 88, 90, and Russia is selling at a $30 discount, they're selling at, call it 58 to 60, they're going to start shutting in production. They're not going to want to sell oil at such low pricing when they have their own budget to manage. They have a military activity going on. They're not getting money from the gas sales because they've shut down Nord Stream 1 to some extent and some of the other pipelines. So there's almost a floor built in that people who say WTI is going to collapse to 65, all the Russian fields are going to be shut in at that pricing. And maybe that's where the volatility comes in. And we live through it, but I definitely think OPEC and Russia will act much faster. And the current supply demand is just not conducive to a collapse either way. Okay, so is nat gas looking more promising for the year? It's hard to say. It's really, really hard to say for natural gas. Like, the natural gas story is getting more bullish and better because we don't have coal. We don't have fuel oil. We don't have extra product sitting around that you can burn. So when you look at natural gas for power generation, the things that people would switch to in the past are not really that obvious anymore. So definitely natural gas consumption keeps going up. Some of the countries upwards of 8 to 10% a year. Look at Iran, look at Saudi Arabia. These sorts of countries, nobody even looks at the natural gas consumption increase. It's running at 8 to 10% a year, and growing fast. So I honestly can't say if it's more bullish or less bullish or more promising. I just feel like I know the WTI thesis a lot better. And if I can get extra natural gas pricing on it, why not? On the Whitecaps of the world, on the surges, on the Crescent points of the world. If you can make money on the natural gas instead of selling it at cost, even better. So Whitecap says they plan to increase gas production. Yeah. Well, the Montney and the Duvernay, the gas production is going to go up for sure. Yeah. Is hedging AECO for the winter a good move? I don't think so. I would buy floors, puts on AECO gas this winter, but I would definitely not want to hedge any upside because this is the year it could go bonkers. And depending on the winter that Canada has, if it's a rough winter with lots of freeze-offs, lots of production declines, AECO could skyrocket, and the US will pay for it if they can export it at 100, well, not 100, but $50 an MMBTU. If they can export it to Europe, Asia, whatever, yeah, I don't think I would be hedging the upside. At what rate do you think they can increase gas? I don't really know what rate they can increase it at, but I think the Montney that they bought currently is 10,000 BOEs. I think they can definitely grow it by 10, 15, 20,000 BOEs a year, and 60% will be gas, 60-ish%, maybe more, depending on what they drill. So take that and add it to their current production. So I don't really know where they would end up, but you could run all sorts of sensitivities on that. Okay, thoughts on Whitecap share price in September and December? Yeah, if I knew, I think I'd be making a lot of money, but I just think overall it's going to go up. The dividend's going to go up. The share buybacks are coming in. The production's going to go up. There's going to be the ESG funds. They're going to buy into Whitecap. They're going to start doing their own share buybacks. And the metrics just can only look so good. And the companies will start reflecting that. So whether it's through increased dividends, whether it's through buybacks, whether it's through other acquisitions, debt pay down, the metrics can only look so good. And then basically people are going to come in and start vulture buying these companies out at super depressed prices. If that happens, we saw it with, is it Kistos or Serica in the UK that got bought out at like a completely unimaginable price because they wouldn't support their own share price with buybacks. So yeah, I think I'm definitely looking at option activity and even equity activity in the Whitecap market. So any thought on Meg's drop in Christina Lake? So not really, no. Like I think most of the market knew that MEG was going to be dropping to 75,000 barrels in Q2 because of this turnaround. The overall yearly production wasn't affected that much, and it's kind of in the past anyway now. So not really much I have to add on this. I think I'm more forward looking. The free cash flow for Q2 is not going to be as good, but they're literally walking the walk. They're buying back shares. They're paying back debt in like 20, $40 million chunks at a time. And keeping the story going. I don't really know what to say. I think MEG is just that steady Eddie that just sits there and I just leave it. I don't even look at the share price. And a year or 2 or 3 later, if it isn't bought out, I come and I collect my profits and I move on. It's as easy of a play to understand as it really goes. There's one asset, there's one product, there's one pipeline, and yeah, not much to it. Yeah, thanks, John. Thanks for attending. So thoughts in general on earnings coming up. Do you think increase in expenditure and costs will hamper the outlook? Yeah, watch for inflation. Watch for inflation revisions. It's not 10 to 15%. It's not even 20 to 25%. Some companies are facing 40 to 60% inflation. On new drilling, on operating costs, you're seeing 20 to 30%, up to 40% on just operating cost. The news I'm getting from my contacts in Grand Prairie is just like they can't find anyone. And what's been happening is the E&P companies are now poaching people from service companies. So they'll go to drilling rigs that are drilling on their land and they'll say, hey, do you want to come operate? Do you want to come be like a labor guy for Crescent Point or for Chevron or, Spartan Delta, whatever. So they know that if they hire people who are green to the industry, they're going to have no oil field experience. But the E&Ps know they can pay more than the service companies. So they go and poach people. It's going to be interesting how this whole dynamic plays out going forward. So yeah, definitely watching the increase in cost, capital cost, and operating cost. And I think the earnings is going to be good. I don't think there's going to be any issues here. WTI averaged, 107 for Q2. So it's going to be good. Watch for the refining companies to do quite a bit better. And I think the messaging is going to be quite important. Again, the messaging is really all that matters. What are you doing with the free cash flow? And how much buyback are you doing? Are you going to support the share price? So dividend increases, watching for that. And yeah, just other cash return messaging. So the SPR release will just extend. They have years left of the SPR. Try me. I think I've said this before. This cycle is the battle of the economist, politician, financial people versus the geologist, engineering, science people. And try it. Try releasing the SPR lower. It's going to be more bullish for oil price than people think to just keep releasing the SPR lower and lower and lower. And the US military cannot afford this. They just cannot afford this to begin with. And yeah, the SPR itself, I mean, the fact that there's been no issues so far is almost mind-boggling. Not just with the cavern integrity, the fact they're able to pump out at these rates, and the H2S issue, the heavy metal issue, the water contamination issue. It's just a matter of time. And again, people are being way too nonchalant about this. They think the SPR is just going to be drawn right down to zero and they can do this for 2 years and keep the game going. Yeah, like I said, from my background, operating wells, looking at them from a production standpoint, looking at wells that have been shut in for 20 years and the kind of condition they end up in. We had our own little gas cavern thing. Yeah, I don't think it's gonna continue on much longer, but just my view, my opinion, and yeah, it's only a matter of time, I believe, till something goes seriously wrong with the SPR. Okay, low gasoline price is good for oil. Yeah, 100%, 100%. Yeah, I didn't used to track the price of gasoline every day, but it's now added on to my daily checks on Gas Buddy, checking the gasoline price in Canada and in US, what it's dropping to, and demand construction. You know, if you're going to tell me that we had demand destruction from $4.50 US gas to 5.1 US gas, you can't just claim that it's not going to come back when the prices drop. So, yeah, I think the demand number is going to shock people this summer in the US, especially if prices keep coming down, crack spreads keep coming down, if the administration removes the excise tax and they make the states reduce it to some extent. Yeah, we could see numbers we've never seen before on August, September gasoline demand. Again, the data has not agreed with this so far, but you know, ignore the last data point. Go to the data point before this 8.0 that got put out last week. It was like 9.47-ish. And yeah, it was July 4th weekend. Yeah, we need to look at 4-week averages. But on the overall, the trend is not as weak as people are claiming it to be, that gasoline sale has collapsed or anything like that. Okay, I kind of want to end it here, but I'm getting lots of questions. So I do appreciate everyone who joined in. So your thoughts on the merits of buybacks versus dividends? I don't really have any strong opinion either way. I definitely think the NCIB has been manipulated. That companies say they're going to do buybacks, and then they say they're going to do buybacks, and their rate of buyback is so slow that it doesn't do anything in terms of supporting the price. So that is a bit concerning. What I would rather they be doing is open an NCIB, buy back the 10% in 4 months, and then in another 2 to 3 months, start a substantial issuer buyback for 8% or 10% of the shares. That, to me, the first company that does that, IPCO, look at the share price. It's been pretty stable. Even on the down days, it's been really, really good. And I think more companies should be doing this. But the dividend thing, again, the first company that comes out with a 15 to 18% dividend, it's going to re-rate the entire sector that day. So I'm just waiting to see who it's going to be. And Tourmaline could have been the one that could have done it, but they instead are paying out the special dividends, which kind of dilutes the regular dividend. But yeah, I think one of the companies here is going to come out with a bang, and yeah, we can take bets on who it's going to be. I'll save my thoughts for now. Yeah, thanks, Mike, for sure, 100%. Yeah, buybacks offer the company more flexibility than dividends. It will not be different. Not really sure what you're getting at, but yeah. Any thoughts on the production read Obsidian put out on Thursday? Yeah, really good. Really, really good. I think Kramer, Karma, and Mistaken, and some of the other Twitter folks have been quite verbal on this, that Obsidian spent a ton of money in CapEx in Q4 of last year and Q1 of this year, and the wells were going to come online and increase production. That's exactly what they did. So I think it's a pretty good report. And as you know, Obsidian's in my portfolio now, so quite happy so far. And I think Steven, the CEO, he's got a chip on his shoulder. Everybody's calling him trash, and everybody's calling him a loser and a manipulator and all this. And yeah, he's got a chip on his shoulder to prove that this is not the Penn West of the Penn West days, and he's not the person that people think he is. I love betting on people like that. If you know my investment in Surge is there's other reasons for it, obviously, but having that leadership at the top that believes in the company, that walks the walk, not just walks the walk, but is willing to put their neck on the line. I can definitely respect that. You know, taking on the market and showing what they can do. So, how are the volumes in the last month? I assume you're asking about the share prices. I haven't really tracked the volumes in the shares. I know the WTI volumes, not the volume, but the open interest has gone down very, very significantly. So I definitely think it's adding to volatility for sure. For sure, it's not even a question. It definitely is. Some would argue that buybacks are too frequently abused. Yeah, maybe. I don't really know. Like, it's easy in hindsight or to look at the future and make claims. What ends up actually happening is a lot different. So, for example, somebody was telling me, and I vividly remember this because this was a really, really good argument, was they said that when the Ukraine invasion first happened, Vermilion should have hedged the entire WTI or TTF strip for 2022 and maybe into 2023. And I said, you know, that's a really good point, but what if the prices just keep going higher? We don't know. And that's exactly what's happening right now. Russia has not even fully shut off the gas yet, and the prices are already higher, not just in 2022, but way down the strip than they were when the invasion first happened. So I think sometimes it's important not just to have a bearish take on things, but a bullish take on things. And buybacks today, if the price of the shares double in the next 18 months, buybacks today will look really smart. And it all depends on your macro outlook and kind of where you see things going from here. And I know that wasn't exactly what you were trying to say there, Tony, but I just added to that. Thanks for the message. Any comments on Surge? Not really. Everything's going great. The wells are coming on awesome. The production's beating. The debt is being eliminated. They have a lot of new acreage in Southeast Saskatchewan. I love those Frobisher fields in Steelman, Lampman, that area. The multilaterals are coming on. Macklin, Provost, everything's really looking good. The first dividend was paid yesterday, I believe, yeah. And I believe the dividend will be doubled before the end of the year. And I'll say that here publicly. I think it's going to be at least doubled by the end of the year. So I think I'll happily take that bet. The hedges rolled off, as you know, June 30th, and December 31st, more hedges roll off that add an extra 15% to their free cash flow into 2023. So all around, why would I sell something like that trades at like almost a 40 to 45% free cash flow yield today, maybe as high as 50%. Yeah, somewhere around there. Which companies were most unfairly punished during this recent pullback? All of them, literally all of them were unfairly punished. So I think the refiners, you're right, the refiners are going to make a ton of cash in Q2. So they were definitely more unfairly punished. Tamarack, I think Whitecap as well. And yeah, Surge, I think it just does not make sense. Surge, ARC, MEG, really I could name every company. I think they're all trading at prices which don't really make sense. And I said this on one of the Twitter spaces earlier, that if I had $50 billion, I would just buy out every one of these companies. Other than the big four oil sands players, 50 billion, I could buy out like almost 1 million BOEs or more of production. That's not the way it should be in a market this tight. And that to me gives me more confidence investing going forward. I can't comment on Suncor. Unfortunately, Peter, I got a close family member working there. Just want to avoid any conflicts of interest. But definitely lots going on there. Yeah, I do know Dr. Alhaji's argument on the SPR, that they don't need an SPR. And it holds merit. It's definitely an argument that, okay, we stored all this extra oil and we don't really need an SPR this big because our domestic production, the US domestic production is really US plus Canada, because Canada doesn't have an export market. So US production can be looked at as like 17 million barrels a day on a consumption of 20. So it's not that bad out of shape. And they maybe don't need an SPR. But let me put it this way, and this is the way I've been explaining this to a lot of people, is without taking anything else into account, think about it this way. Do you think the SPR release right now has dropped the price of oil? Okay. If you say, if we didn't have the SPR release, the price would be 150 or 120 or 130. You're agreeing that the SPR had an effect on the price. Okay. Once the SPR is gone and we are in the same supply demand deficit and we're in the same scenario with a supply shortfall, would that price not come back into the market? There's your answer for why you may not need an SPR, but the price you're going to pay is going to be a lot higher if you don't have that insurance policy, this massive insurance policy built in. And I think that's the point that a lot of people may be confused, is you may not need anything. You may not need an SPR, but you have to pay more in order to survive in that sort of new world. Both points can be correct. They're not competing points as much as it seems like it is. Those 2 points don't really compete with each other. The main point is that the less insurance you have, the more people are willing to pay up front. And I think I'll leave it at that. If there's any more, I would love to expand on that, but I don't want to drag this on too long. But yeah, great comment there, Anders. I do appreciate you bringing that up. Shalenden, Shale and nice, I like that. Yeah. Talking about free cash flows, have you looked at coal companies? No, I haven't looked at them. I know there's lots of conversation going on, and people are looking at them with 100% free cash flow yields and whatnot. I don't think I would ever buy a coal company. People were pushing uranium pretty aggressively 6 months ago, and I didn't even look into that. I like to invest in things where I have an edge, and I don't have an edge in coal. And I wish them all the best. I'm not saying it's going to go down or going to go up. I just don't look at things that I don't have an edge in. I think in the short term, these sorts of things can hurt your performance, being so narrow-minded. But over the long term, investing in random things, which I haven't had time to look at the macro or really deep dive into these companies, I don't think is prudent from a long-term, not long-term investment, but over a longer time frame. You will probably end up losing more money by blindly investing in some of these. Just my opinion and the way I run things. I've been through some massive drawdowns. I've been through bankruptcies in the companies I hold and other issues in some of the other companies I'm in. If you look at the helium play and the manganese play I'm in, I invested in them based on pretty significant research, not as much as I do in oil, but pretty significant research. And I'm getting absolutely railed on both of those holdings. So yeah, it's not as easy as it looks, I guess. Okay. Has this pullback in names got you looking into options? Yeah. In fact, I was pretty close to selling all my equities except my junior names and just buying options on everything for summer 23 / early 2024. And I kind of decided against that because the premiums that I was looking at were not good. I was not getting the leverage that I was wanting. But yeah, I definitely think I'm looking at options more now than probably I ever have, to be honest with you. Yeah. Okay. With ACO Henry Hub going up, why do you think Birchcliff New Vista are not going up? It's just the overall liquidity, I think, in the market, and ACO actually is not going up that much. It's ACO has been in contango for a while now. I think the Canadian transmission and transportation people realize that, look, if we keep sending all this gas to the US and burning it, we're going to be absolutely screwed come wintertime, where people can actually die. And what happens when that's the case is they will push the curve into contango and start forcing people to store gas instead of burning it or transmitting it. And that's literally what happened. I can pretty much guarantee it. That's how the Canadian ecosystem works. They cannot go into the winter the way we were heading into it a month ago. So keep an eye out on the ACO differential to Henry Hub. It's not always constant. So basically from here on out, you're just oil only? Not really, no. I still have lots of gas exposure through my Montney plays, my Spartan Delta, my crew. A lot of the oil companies are still 20 to 30% gas. So I have enough exposure that I need. I'm not looking to add any strictly gas plays. You're right, no strictly gas plays. Okay, so I'll end with this question. The White Tundra portfolio is still tagged as June. Yeah, you're right. So last week I did say I was going to update them, and then I had to make a couple changes with the way my margin was set up. And then I started looking at these options pretty aggressively, possibly switching out the entire portfolio. And I still have some ideas in mind that I want to do. So I haven't updated it yet, but the portfolio largely has not changed from the June 2022 tag. Basically everything has really gone down to the same extent almost. So I did lose my Whitecap options for July. They got zeroed. So, but that's not a huge holding. So yeah, so basically it's still directionally correct. I haven't added any names. I haven't sold any names, not really. Yeah, basically everything came down to the same level. And yeah, I'll leave it there for now until I kind of decide here what to do this week, and then kind of go from there. Yeah, I could sell puts, Magnus, but I don't have enough cash to secure the puts, and TD won't let me do things that way, unfortunately. So yeah, as much as I would love to do that right now, if I sold all my equities and just sold cash covered puts, I'm not giving myself the upside that I really need. It would be just about collecting premiums, and I'm taking on significant risk in terms of some sort of event that happens 2 years out that we don't know about, so yeah. Yeah, it's never good looking at the options getting zeroed out. Trust me, it's not fun. And I think it's been a pretty rough month for a lot of people. So it's important to take things in perspective, look at the last 2 years, look at where things are, look at the shape the companies are in. And my goal now, every company I talk to, is get the damn NCIB filled. Like, buy the 10% back at this pricing where it is today, and start the substantial issuer buyback. Like, never mind the debt. The debt can be dealt with later on. But if you can buy back 20% of your float at today's pricing, if Surge or a Meg can buy back 20% at today's pricing in the next 2 months, it's going to be such a massive difference 6, 12, 18 months from now in terms of the compounding effect of that, that I think it's going to pay more dividends than paying off debt. Paying off 3% debt doesn't really make all that much sense. But yeah, we'll end it there. Thanks again for everyone that joined, stuck around. Always goes longer than I expect, but I love interacting and kind of sharing my opinion, my thoughts. Love the questions. There's a comment here on an option session, so I'll think about it here as I kind of go on. I've been moving into my new apartment beginning of August, so just busy with a lot of things going on and traveling, lots of road trips and camping and whatnot happening. So I don't want to sign up for a session and then find out there's other stuff going on. There's also the world's biggest cars and coffee meetup, I guess, in San Clemente every Saturday from 10 to 12 Mountain Time. So it kind of contradicts the timing of the session, unfortunately. And for people that know me, I love vehicles and sports cars and vintage and all this. So I might adjust things here as I go, but definitely still want to continue as much as I can giving back. I'm going to go back to my daily posting on Twitter. Been kind of slacking off on that. So I'm going to get back on that and post daily, something that I see, info, data, whatever I'm looking at, and kind of just go from there. And yeah, housewarming parties on. If there's anyone in San Diego, Orange County, I'm always down for coffee, drinks, drives. Yeah, whatever. Love talking oil. I've met so many great people in person, in Calgary, in California, all over the place. So yeah, always open to that. And thanks again for everyone who take the time on your Saturday to join and listen in, learn more, and share knowledge, insights, thoughts. And